a question? Looks like there's one in the back.
Hi, my name is Mesh Tandon with Simran Capital. How are you?
Good.
My question is really in regards to looking at this credit crisis in retrospect. You guys have some fantastic ideas on the markets today. What would you say is, in retrospect, the one or two ideas that you think went wrong in the credit crisis? Simran Capital manages a high-yield product that did phenomenally well in the credit crisis. We outperformed the benchmark by 60%, but I want to know really what your thoughts were on what went wrong in the credit crisis. Thanks.
Quick thought? Jim seems up your alley.
Yeah, I mean, I think we've been kind of covering it. I think that I would just sort of, just in the interest of time, rehash kind of a lot of the stuff that we've been saying. I don't know if you guys want to add.
I think the old adage that more people have died reaching for yield than in war is, I think, right. And that, people thought there wasn't volatility. People thought you could stretch and buy that single B bond and it was just as good as that AAA, and it just wasn't right. And so there's one metric that I always ask people to remember, which is any time levered companies start issuing zero coupon bonds, that always, always, always means we're about to have a collapse. Because by definition, those companies don't have enough cash flow to service their debt. And so the only time they're able to do that is when there's so much money that's flowed into fixed income leveraged products that those people will buy the bonds. And every time, with Drexel in '87, in the TMT leverage bubble in 2002, and then in 2007, companies start issuing zero coupon bonds, and there's always a collapse right afterwards.
By the way, I don't think anything went wrong. The reality is that it corrected a lot of issues, right? There's issues, as Charles just mentioned, there are telltale signs that things were completely out of whack, and yet it happened anyway. And so a lot of people felt a lot of pain. That's the way it should go. So no, I don't actually think anything went wrong. There are lessons that people should take away from each scenario, but the market overreacted, but it always does on the upside and the downside, just obviously to an extreme. But in my view, nothing went wrong per se. The market acted like it should have.
We have time for one quick question, if there is one. Yes, over here in the front, and we'll make this the last one.
Hi, David Kenzie, Aurora Investment Management. Just curious, when we talk about kind of what happened at banks and we talk about the incentive issues, I think to me that's what drove kind of this policing type of risk management approach at the banks, because often the traders weren't incentivized to necessarily mitigate risk. And I think that we've seen a transfer of that approach to risk management to the investment management industry, where clients are asking for more of a policing approach to risk management, which I don't know if that is often productive from the perspective of the investment managers, who may have a lot of skin in the game and may have really strong incentives to perform well for their clients. I'm just curious about how you think about that issue.
Maybe
Sure.
one comment?
Yeah, I would just say, I think on our side of the table, I think it's sort of, different products for different folks. Whatever the clients can sort of seek out what type of risk they want to take, what type of products they want. And that generally polices itself, because certain types of investors are attracted to certain types of strategies, and they'll either do well or they won't. I think it's a little different with the large financial institutions, and the reason I think this period is different than a few years ago is that our government did, you and me, did bail out financial institutions. We're still subsidizing them today. They issued 0% debt, so they have a cheaper cost of capital because of us. There's word that the Fed is going to begin paying interest on reserves. That is effectively a subsidy, arguably, but effectively a subsidy. So these are government-subsidized institutions, bank holding companies, government-subsidized and monitored institutions. And so I think risk management at those institutions needs to be run a little differently. If in the private market people want to shoot for 1,000% return or lose their money 80% of the time, they should have every right to do that. And they're private investors, and they can have the right to do that all day long.
The only other thing I would add to that is, I don't think any of the individual desks, well, not many of them, you mentioned that they were allowed to take on excessive risk. This may be scary, but I don't believe a lot of them knew they were taking on excessive risk. I'm not sure anyone There's not many who came and said, look, yeah, you've got a ton of risk on, but that's okay, and understood it. There obviously was a lot of risk that was taken on that people didn't understand, but I don't think there were, in most cases, was an explicit understanding that we're taking on a ton of risk. We know we are, and let's just hope it works out. They learned that after the fact. So if you want to look at risk management, don't look at it as a, boy, a lot of people did some really stupid things and they knew that they knew they did. A lot of people did some stupid things that they didn't know they did.
And with that, we'll close the session. I'd like to thank the panel.
Thank you.
We're going to take a brief break and reconvene here in a few minutes. Thank you.
Thanks. Thanks.